Hello, this is Kelly Fasterling, financial advisor, real estate investor, realtor, coming to you today to talk a bit about long term care. Let's talk first generally about the topic. The purpose of long term care is really to cover you in case you lose some of those, what are called those activities of daily living. There are six of them that are defined, and they include being able to bathe or dress yourself, being able to eat by yourself or move from location to location by yourself, continence, and being able to toilet yourself. So, all of those really basic things that we do during the day. Now, as we age and we have our baby boomer generation really moving through and into retirement, as we age, 70% of the population will usually require some kind of care. And then the question is, how do you make sure that's handled and covered? Now, historically, as you look at how it is covered, 80% of that care is usually provided by spouses, by kids, by folks that are unpaid for that care. And the average length of time that we're caring for somebody that may have had a stroke, a heart attack, or just need some extra assistance, the average length of time that care is needed is about 4.3 years. Now, if that care gets to be more than a spouse or children can handle with their schedules or their physical capabilities, then assisted living may be the way to go. Assisted living, the average cost right now is about $54,000 a year. So it takes a pretty big bite out of anyone's expenses and savings. And it usually lasts, on average, about 28 months. So a bit over 2 years. So that's, at that average, that's over $100,000 of expenditure that may or may not have been planned. And then if you don't have anyone that can care for you and you do need to go into a facility where you can get some help, what are your options to really plan for that in advance to make sure you've got some coverage? So let's talk about the 4 different ways that you can accommodate covering some of the costs of long-term care. The first is you can buy a long-term care policy. Those have been available on the market for many, many years. And years ago, for what you paid, you got a really significant value for it. Anymore, and it could be that the changes in population and the changes in aging, anymore, the premiums continue to rise. And so the amount that you pay for the benefit you get, you have to really evaluate if that's a good use of funds. The biggest drawback in getting long-term care insurance today is that those premiums can continue to increase. So you have to evaluate that. When you look across Americans, the amount of people, the number of people, the percentage that actually have long-term care insurance, it's about 3.3%. So it's not a high volume of folks that are moving into option 1, long-term care insurance. Now, option 2 is to self-insure. And frankly, this is where most people sit. They self-insure when a problem comes up, they cover it. They pull it out of their savings and just manage it. If you need some in-home insurance where you may need some nursing care or cleaning help or cooking help, that can come up to a couple thousand a month if you don't have family that can assist. Assisted living, we talked about that average of $54,000 a year. That's, $4,000 to $5,000 a month, kind of in that ballpark. Semi-private nursing, if you kind of even up the level, you're looking more at $7,000 a month. So insuring yourself and getting to the point that you need the help can also be an expensive proposition. Now, there are two other ways to provide a little financial assistance for long term care. One is with an annuity. An annuity is a life insurance based product with a life insurance company. And most annuities, should you come upon health concerns like a terminal illness, a chronic illness, a critical illness, most annuities will allow you to fully liquidate your account should that happen. So that's usually an available option. Now, that's just really spending what you have. But there are annuities that allow you to put on an income rider. Maybe there's usually a charge for it, a rider charge for it. But with that income rider, you have the ability to turn on a guaranteed income stream, and some of them allow a doubling of that income stream. So let's just say that you put money into an annuity, you went 10 years, and then you do have a health concern and you need to turn on the income rider and get some additional money out of it. And you can turn it on, and then if you were supposed to get 5,000 a year from that income, it would double and make it 10,000 a year. So that becomes an option, an annuity with an income rider that has a doubling clause. The fourth option is in the life insurance arena with actual cash value life insurance. So cash value life insurance would not be term insurance, it would be whole life or indexed universal life. And with that cash value life insurance, really when you pay your premiums, you're buying a death benefit that's significantly higher than your premiums. So you have access in many of the policies to tap into that death benefit as a living benefit. So before you die. So if you put a policy on you and you're putting your premiums in, and let's just say your death benefit is $800,000, but your premiums, you haven't paid near $800,000 for that death benefit. Should you pass, that death benefit goes to your heirs tax-free. So that's a benefit. But if you've got a terminal illness, a chronic illness, a critical illness, and you have some needs for those funds prior to passing, in numerous of those policies, they'll allow you to tap into a percentage of that death benefit, that 800,000 we're talking about. Maybe to 25% of it, 50% of it, 75% of it, depending on the kind of illness you have. So now that allows you to get access to funds that really you haven't yet put in there. So that becomes a really nice way to consider funding some long-term care needs, some costs in, that last year of life for us tends to be the most expensive medically for us. So that's when quite often we need those extra funds. So life insurance becomes a way to tap into the death benefit, tap into a savings pool that you didn't put away for, but you have a benefit of, and take a percentage of it. So that's an opportunity. Now let me talk just a touch about in the federal system for federal employees. If you wanted to get life insurance benefits, how could you go about doing that? Well, in the federal system, they do have federal long-term care insurance. It's called FLT CIP, Federal Long-Term Care Insurance. So it's a group long-term care policy. It's available to you as an employee. It's also available to your family members. And you can step into it and enroll in it at any time. Now that premium will be based on your age when you apply for it. Now we talked earlier about one of the drawbacks of long-term care insurance is that the premiums can go up. In 2006, that premium for that federal long-term care insurance went up about 83%. So that was a really big rise in the insurance. So you can expect to see some changes in the premiums for long-term care insurance. The other potential drawback is that the benefits may change. They may not be guaranteed. So there's not necessarily a promise for service. So if you're looking into long-term care, whether it's through the federal system or whether it's through a private group, just double check on the premiums. and any expectation of change there, and double check on what promises, what services are guaranteed for you. And typically, with that federal long-term care insurance, there's generally a maximum daily benefit, how much they'll pay you every day for a set number of years, for maybe 2 years, 3 years, or 5 years. So that's typically how the plans are structured. If you need care for 10 years, then you're moving back into some self-insurance or the life insurance and annuities. So you have to really evaluate all those options. So to summarize, what we talked about is making sure you have a plan for covering your long-term care, because about 70% of us are going to need some kind of long-term care, whether you're relying on family to help or whether you want to make sure you get funded. And if you're funded, you're going to look at purchasing long-term care insurance. You're going to look at, well, self-insuring. You'll look at an annuity with an income rider with a doubling clause on it to give you a bit more. Or you'll look at cash value life insurance that gives you the ability to pull back from your death benefit. So that's it for today. You have a beautiful day, and make sure you're kind of looking out for what that future will look like for you. Take care.